Friends, in this I Thought Wealth video, I'm going to talk to you on the topic value versus growth. How do they stack up? At the beginning of 2020, the consensus view was it made more sense to buy growth stocks, especially the defensives like FMCG. The amount of hype around some of these companies, which no doubt have done well over time, like Levers, Asian Paints, Pidilite, was quite strong. Pundits also made a story out of this by saying that these are the only companies that one can really invest for the long term. It is very easy for somebody who has just entered the stock market or who is not a keen watcher of trends to mistake such advice as gospel. But in investing, there is nothing called gospel. You will see a Warren Buffett buying a gold mine or even gold. You will see him buying airlines. But you would also heard him say years ago that these are something which he would never touch. So, preaching and investing can really confuse the person who learns from you. That, in my view, is the greatest danger in investment learning. So, let's come back to the fight about whether growth is the only way or whether there is any merit in value. I'll just use this year's data point because after all, in the beginning of the year, the pundits were all over the place giving a prophecy that Levers is a must-own company. There's no company like Asian Paints and stuff like that. Before I go into the merits, let me tell you that I have owned these very companies from a time when the investment cycle peaked out to the time when the investment cycle was at a standstill. The reason was that I felt that once the investment cycle peaks out and then starts slowing, it's a matter of time before consumption stocks come back. And I also hold the view that once the investment cycle breaks off from the standstill and starts growing again towards its next peak, the consumption stocks will gradually wear off. So this is basically why I am doing this video, to explain that probably we are around the peak of a consumption stock rally and we are around the bottom of the investment cycle. This is a typical time when you need to revisit your hypothesis. And the market knows it. That's the beauty of the whole thing. The market is a very keen observer. And here is some data. On January 1, the stock prices of Nestle was 14,779 and today it is 17,802, which gives a simple return of 20.5%. If you take Levers, it was 1936 on January 1 and it is 2187 at yesterday's close, giving 12.96%. If you take Asian Paints, it was 1795 and it is now 2444, which gives a return of 36.13%. But one point to note in Asian Paints is there is a 5% selling overhang waiting to happen. And after that, we don't know where it goes. The last point is on Pidilite, which was 1395 on January 1 and it is 1607, now translating into a return of 15.2%. Now, this is your FMCG basket, the cream de la cream of FMCG. Now, let's compare it with what we call as the untouchable stocks from the metals pack. First, JSW Steel was 258 rupees on January 1. It was 370 rupees at yesterday's close, translating into return of 43.4%. Tisco was 468 on January 1. It was 623 at Friday's close, translating into returns of 33%. Hindalco was 214 on January 1. It is 252 at yesterday's close, translating into a return of 17.8%. So, you see that metals have actually not done as badly as consumption stocks in a year when the investment cycle went nowhere. Now, if post a Biden presidency and post a lot of disinvestment, we see investment cycles revive across the world and countries spend more on their infrastructure so that they can revive investment, it's very likely that this defensive hypothesis that stands that FMCG is the only safe place can get revisited. People will revise their expectations and they will gradually lower their expectations from consumption stocks. The over ownership that we see today, which is quite rampant in consumption stocks, will gradually wear off and that will reflect in the valuations. So, saying that this is the only thing to do, those are things that you should never do, is basically not educative or evocative, because the markets are dynamic. Consumption stocks and investment cycles are connected in an inverse way, and when investment cycles do very well, consumption may possibly not do as well as this, because here the operating leverage which you can see in beneficiary companies can be tremendous, which could lead to a very sharp expansion in shareholder value. One thing that most people don't realize, that if I gave you the balance sheet of a company which is in metals and the balance sheet of a company in FMCG, the only difference that you will see will be leverage. Otherwise, debtors will be low, inventory will not be too high. The main difference is leverage. Borrowing will be there in metal stocks, borrowing will not be there in FMCG stocks. But understand one thing, when your cost of finance is between 3 and 0, leverage is likely to reward than punish. So therefore, it is possible that not too far away in the future, the very same pundits who are hypothesizing that consumption is the only way may well revisit their hypothesis and come and tell us new stories about how leverage is a great way to improve shareholder value, because there is no cost to it, and if a company is able to earn more and do more business, then that leverage will go away and the shareholder value that is created vests squarely with the shareholders. In the sense, more headroom for shareholders in commodity companies than in consumption stocks. So the prophecies can stand on its head and we would still be listening to those interesting prophecies. So that's about it. You can never say that this is the way or this is the only way, nor you can say it is my way or the highway, because the stock market is a place where the road less traveled is probably going to take you to a better place. Remembering that is very important to every one of us, and that's what would give us outlier returns. Being in the herd would only make us one in the herd, and that's something I would strongly exhort you to avoid. Thank you for watching this video. Do subscribe to our channel, do share this video with your friends, and do keep supporting us. We would give you independent views from time to time on investing strategies and the art of getting rich. Thank you.